There are so many alternative investments out there that you can put your money into depending upon what your manager puts you into, from commercial real estate, residential real estate, rental homes, commodities, commercial development, private equity funds, venture capital funds. Heck, there's one guy I was talking to today in Orthopreneurs who just built an RV park. Now again, many of you sit there and go, I don't know the first thing about this. You're not supposed to. You're supposed to find experts who guide you on this. Hello there, everybody, and welcome to another episode of Your 5-Minute Friday. I'm your host, Dr. Glenn Krieger. Today, I want to talk about investments. I want to talk about money and your future. Now, crystal clear, I am not a financial advisor. I don't purport to be one, and please don't take me as one. But the conversation I'm going to have with you right now is going to happen one of two ways with you. You're either going to hear what I have to say and go, wow, that's crazy. I never thought of it that way. Or you're going to be like, this is silly. I don't believe in this. This is dumb. And all those voices in your head that say can't, won't, shouldn't are going to start popping in. But I want to talk to you about money and investments and why some of you out there are selling yourselves so short on what you think you can get as an annualized return. So I recently asked an Orthopreneurs, what do you consider a reasonable rate of return for the next 15 years over an annual number? So do you see 3%, 5%, 8%? Now, I don't want to know what you use in your calculations as your safe bet. I don't want to know what you think of as your least, lowest number. I want you to tell me that if you were going to say, look, for the next 15 years, annually, I would like to get this kind of return every year, right? And the numbers that I was seeing were blowing me away. 5%, 6%, 7%. Now, mind you, folks, the Standard & Poor's average over the last 30 years is 10.6%. That means if you bought an index fund where it just follows the S&P and just put your money in it and never touched it again, let it go up, let it go down, do whatever it does, you would average 10 to 11% over the last 15 years. And again, you're going to get into the argument with me of what about the dividends that get taxed? What about inflation, et cetera? We're not going to get into that because some of that is incalculable on this kind of conversation. But the average annual return for the S&P 500 is 10.6% over the last 30 years. Don't believe me? Go look it up. You want to know what it was over the last decade? Way higher than that. Index funds have 16, 18, 20%. Well, 18.6 is the highest I know in the last decade. But my point is, if you're selling yourself short and saying, well, 5% seems like a really good number, that's all well and good for you. Maybe you have no risk tolerance. But here's what I want to tell you about. I had to talk with a couple of money managers after that post, and we all sort of giggled a little bit, not in a funny way, but kind of a nervous laughter, that professionals who make so much money are willing to do a couple of things that they disagreed with. The first was tying up all their money in the stock market, right? The old adage, put some money aside every month, put it into stocks, bonds, mutual funds, index funds, and you'll be fine, is true. But the overwhelming majority of the truly wealthy people out there did not make their money in the stock market. I want you to look around your life at the people who you know of who have the most wealth. And I'm not talking about inherited wealth. I'm talking about accumulated wealth that they've created themselves. The overwhelming majority didn't get it by putting money into mutual funds and stocks. There are so many alternative investments out there that you can put your money into depending upon what your manager puts you into, from commercial real estate, personal, residential real estate, rental homes, commodities, commercial development, private equity funds, venture capital funds. Heck, there's one guy I was talking to today in Orthopreneurs who just built an RV park. Now again, many of you sit there and go, I don't know the first thing about this. You're not supposed to. You're supposed to find experts who guide you on this. So for me, when I met with my financial advisor the first time, and he said, great, we're going to put you into stocks, bonds, mutual funds, I said, goodbye. Because that's not me. I'm an entrepreneur by spirit. I want to invest in startups. Some are going to fail and some are going to succeed, but you're not going to put all your money in startups. But I want to invest in commercial development. I want to invest in residential real estate. And in the RD group I've brought people to them who do this. And take private equity, for instance. Private equity, as the name would imply, isn't open to everybody. But as orthodontists and those associated with the ortho industry, you may make a living that's good enough that lets you get this access that's limited. And a top private equity firm, a top 25% private equity firm, will make you on average, statistically, between 23 and 43% annual return. That's a little different than 5, 6, 7%. Some of the firms that are out there are more than a top 25% and are showing, I know one personally that I'm invested in, that in its first fund got a 3.2 to 3.3x in a little over 3 years. Their second fund is on pace to do the same, and their third is now open to investments. That's a very different ballgame than me taking my money and putting it into Microsoft or Tesla or wherever else I'm going and pretending that I'm going to beat the market. And so I want you to just, if this does one thing for you, this whole conversation, I want you to start broadening your horizons and looking for investment folks who are going to help you vet effectively alternative investments so that you're not going in and saying, 5% per year would be great, when in fact, you could very well be seeing very different numbers, because 3.3x over 3 years is a very different return than 5% per year, all right? And again, good private equity funds will get that for you, and you need to start looking for them. What's the downside? They're not open to everybody. Some of them have minimal opening of $250,000 or $500,000 investment. Some of them only take 100 people. But as one fund manager said to me, he said, Glenn, you ever sit down with your financial analyst and he says to you, and many of you have heard this, the market's down 18% this year, but good news for you, your portfolio is only down 8%. We beat the market. He said, if I said that on one of our investor calls, I would be out of a job instantly. My job is to return a positive investment every time, and I've got to do that. And that's what private equity investors expect, and that's what their fund managers do. So again, start thinking outside the box, start thinking differently about how you can invest, and speak to your financial advisor and see what they say. But again, if all they sell is stocks and bonds and mutual funds, that's what you're going to get. And I hope I get to see you on the summit at opsummit2024.com. There's a lot of conversations like this that are had on that boat. And I'm telling you now, going on that cruise is going to be one of the best investments you can have, because this one's fully guaranteed. If you don't think it's the best meeting you've been to, I'll give you back every penny. So go to opsummit2024.com. I hope to see you there. Much love to each and every one of you.